Well, hello and welcome to yet another episode of Global Mantra, the show that brings to you prominent fund managers from the City of London and gets their views on the current global market environment. Joining me on the show today is Willam de Vijlder, who's the CIO of BNP Paribas Investment Managers, and he's right here in the studios with us. Willam, it's great to have you on the show. Thanks very much for taking out the time. At the start of this year, you had made sort of a projection about emerging markets versus developed markets, and I just take your quote on that one. You expected emerging markets to give a return of at least 20%, whereas developed markets you were expecting would be less than 10%. Now, the first quarter, as far as equities is concerned, we've seen a very different scenario. How would you explain that?
Yeah, I think we have seen a kind of the perfect illustration of an element which was completely, I would say, out of the blue in terms of the geopolitical developments, and starting in one country and then impacting other countries as well, and leading to a different way of reading the macro environment as well, because of the impact it has on oil and the impact it also has on uncertainty. So that was clearly, I would argue, one driver. The second driver is that we have been disappointed, and generally speaking, investors have been disappointed about the way that some countries had taken a stance on inflation. At the start of the year, there was a bit of an impression that a number of emerging countries were taking the inflation risk quite lightly, and that led, of course, to profit taking, because there was a worry that inflation would just completely get out of track. So that was another reason. Then the third argument is that we have seen a surprising string of very good macro data, certainly in the US, where not only the data were good, but they kept on surprising to the upside, and that has, of course, given a lot of confidence to global investors that actually there was more dynamism in this cycle, and also in earnings in the US, and then by extension in Europe, for instance, which has led to rebalancing from emerging to developed.
So what were your positions like at the start of the year, and how have you tweaked them now?
Well, actually, we have not tweaked them that much. At the start of the year, we were overweight in emerging, overweight developed as well, but more overweight in emerging than developed. And we were long on credit, and specifically via high yield. And we were also long on emerging debt and in local currency. And basically, we have held on to these positions. We have had some minor changes, but they're really minor. The strong calls, I would say, for over the past and for the coming months stay as they are. We think that high yield is still attractive, purely to pay the carry. And we think that the underperformance of emerging compared to developed has actually gone too far, and that the valuation support is still there, and that we will actually gradually see a recovery in emerging markets equities.
So you're saying that in the second half of this calendar year, you see a surprise perhaps in the works from emerging markets in their outperformance, or would it be a net neutral performance closing the year out flat, given that the first quarter has been a bit down for these markets?
Well, we should still be able to finish the year on a positive note, meaning with a net positive return. The reason being that although there have been inflation worries, we are still in a positive growth environment, all the more so because OECD is not doing that bad either. Looking at US, looking at a good part of the Eurozone, not all of the Eurozone, but let's say Germany and the Northern European part. Thirdly, let's not forget that in the second half of the year, we will see a bounce in Japanese data as well, because of the rebuilding effort that needs to take place. So the broad macro picture from a growth perspective is still okay. Secondly, the liquidity environment is still supportive as well. In the majority of countries, we still have a very easy monetary environment when you just look at, for instance, at the level of real short-term interest rates. So that's another important aspect. And then the valuation, when you look at valuation, they're not that demanding. So putting it everything together, that should be okay, unless there would be some I don't know what big factor that would weigh on risk appetite, and a factor could be that, for instance, geopolitical factors would again be something weighing on that risk appetite.
So how does your portfolio look like at this juncture across asset classes and within an asset class, especially dividing it between emerging markets and developed markets?
Well, the first point is you still need to diversify. The concept has been much criticized. The other day I was reading an article on the myth of diversification, and I think that is far too negative. And we have seen with the recent developments that sometimes there is portfolios benefit from the negative correlation between what bond yields are doing and what equities are doing. So diversification, one. Secondly, I think developed still benefits from this impression, from the feeling that growth is actually pretty okay, and that on a relative basis, actually developed has gotten more attractive compared to emerging, which is a totally different picture than the one that we had at the start of the equity rally, which was in March 2009. So the list with question marks on developed has gotten shorter. The list with question marks on emerging has gotten a bit longer, and this is really to do with what is inflation doing and what is being done on inflation fighting, and that's where we still are in that situation. So now with respect to emerging, we still think that you have to be there, because the emerging growth story is far more sustainable, structural than on the developed. I think the worries that we need to have on developed next year is that the impact of fiscal tightening will kick in. So looking at emerging, there you need to differentiate between different countries. I think what we are really looking for now from a country allocation perspective is China, Korea, Taiwan, Russia.
I don't hear India there.
Well, India is not on the list. It's a relative game. You cannot be overweight in all the markets, of course. And on a relative basis, we think actually that India has to wait a bit, and that really is related to the valuation background, and it is related to the inflation background as well. And we think that, for instance, China, from a valuation and interest rate and inflation perspective, is more attractive than India.
All right, Willam, we'll take a short break on that. Now, when we come back, we will discuss emerging markets in detail, which are the markets that Willam is bullish on, which are the markets he's avoiding, and also where is money flowing at this juncture as far as developed market opportunities are concerned.
Corporate bonds in emerging markets are attractive because emerging markets as a country, as a grouping, have pretty attractive balance sheet fundamentals. You add a spread which on an equivalent rating is higher than in the developed markets, and then you have the currency argument, so it's quite compelling.